Hello there. Welcome to The Close. I'm in today for Mirella Fernandez. Let's get to the big stories we're bringing you from our newsroom. The Globe and Mail says Rogers Communications is offering buyout packages to about half of its workforce. The paper says the telecom giant is making these voluntary departure packages available to employees across multiple divisions as it moves to significantly cut costs. The offer comes as the telecom industry faces slower revenue growth in Canada. The company is also reckoning with high debt levels. Rogers has introduced plans to cut capital spending by up to 30%. And the Globe also says the federal government will forecast a lower deficit in tomorrow's spring economic statement. That's set to be released by the Finance Minister, François-Philippe Champagne. The current fiscal plan projects a deficit of more than $78 billion for the 2025-26 fiscal year and more than $65 billion for the fiscal year that began April 1st. Shares in Domino's Pizza down 9% today. The company missed on earnings expectations in its latest quarter, mainly due to a $30 million loss from its investment in DCP Dash, a food delivery service that relied on independent contractors rather than store employees. And there's a look at the TSX under a little pressure today. Let's check in on the U.S. markets because both the S&P 500 and the NASDAQ have hit record highs today. So U.S. stocks hitting record highs. There seems to be spotty progress at best in resuming the peace talks between the U.S. and Iran. Huge week for technology. 5 of the so-called Mag 7 companies reporting earnings. Let's get more from BNN regular Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Great to have you here.
Thanks, Andy.
Do you think the U.S. market could be headed for the wall if it turns out they've overspent on AI?
No, I think we're going to get a period of time where the U.S. market starts to outperform the TSX for a little bit. I think now is the time for technology, or what we'll call secular growth, to kick in. And, since, I would say last July, a year ago last July, the TSX really started to kick in. Remember that we had a period of a significant historical underperformance because commodities kicked in, gold kicked in. And now I think we're at that point where the materials and commodities and energy sector, even though they have a wonderful runway in front of them, they need to digest their gains. So I think you're going to start to see some money flow back into the Mag 7, into semis, into the infrastructure names, and possibly for a short period of time, a catch-up trade in software as well.
Let's put up maybe a one-year chart for XBM. It's just pretty well at random, but it's an ETF that tracks base metal miners. You think that sector could be due for a pause anyway?
Yeah, mining is a difficult business, right? And so I hate to use this term, but I'm going to. The easy money's been made where all the mining stocks go up because the commodity prices have gone from very, very depressed levels to a point in time where we get CapEx kicking in. Now the CapEx cycle hits, and now what's going to happen is the mining companies are going to have to play Bay Street or Wall Street game, and their business model really isn't set up to participate or to survive in a spreadsheet type world. Margins every month have to go, quarter have to go up. So I like them. I think we've got a period of time where they're going to go higher, but I think they digest here.
And tech, the question, I guess, one question we've yet to see is, will AI mean a profit bonanza for corporate America? Because where will those profits come from?
Yes, and I think the interesting thing 3 or 4 weeks ago it hit was AI is no longer a productivity gain. It is a financial stability and trust game. And so we had, I think, the governor of the Bank of Canada talk to the banks on Bay Street And the Secretary of the Treasury and the head of the Fed talked to the banks on Wall Street saying, you need to spend on CapEx to deal with AI because it's a matter of financial stability. So now we get the banks coming in and spending on it. So yes, it is a productivity enhancer, but I think right now that we're going back to the 90s, Andy, we're still building the platform and it's still early days.
For this powerful computing, you mean?
Yeah, so think of AI as a platform like the internet or electricity. And when you do that, you want to basically buy the infrastructure, the picks and shovels. The previous segment was on semiconductors. That still has a long way to go. Think about when we were working in the 90s, when the internet and the computer got introduced. It took longer than we thought. There's a thing called Amara's Law, which means what we do in this business is we over discount what is going to happen in the short term, and we ignore the profound changes in the long term. So I'm very bullish on tech, secular growth, and I think you should continue to pick your spots.
Give us another thought about a long-term trend investors may be ignoring unduly.
Demographics. The younger generation is getting into family formation years, albeit later than the boomers. And, you know, they're going to buy houses. They're going to save for their retirement. They're going to save for the kids' education. And typically that is very good for secular growth. And that typically that is good for a bull market. So you have that. And then we can't ignore Trump and the America First. That is a theme where the United States is going to retool its physical economy, its manufacturing base. That is a massive theme, and you're still seeing good earnings and good orders, and the stocks are doing great.
We have a federal government that's happy to spend taxpayers' money on stimulating growth. Other people's money, I guess all politicians do that. How do you feel about the TSX over the next 5 years? Do you think we are going to get the economic rejuvenation the Liberals are talking about?
Yes, we will. I think Carney's doing an admirable job. I think under the surface, he's trying to implement the same strategy that President Trump is. He's focused on economic sovereignty. He wants Canada to be independent and strong. But at the same point in time, he needs time. And he, Canada has really done itself some harm over the past 10 years in terms of its economic policies. So yes, I think Canada is going to be okay. I think Carney's doing a good job. It's the period of outperformance we saw in stocks over the past year, I think is gone, right? I am a bull on gold, right? I think gold can double from here to the end of the decade, but so can the S&P. Right? Same thing with commodities. So where are those other areas going to be? So I'm constructive, but at the same point in time, he is dealing with an electorate and a society that has gone extremely to the left. And he needs to pull it back to the center, and he's doing it slowly.
That's interesting. You feel, corporations, I guess, complained in the Trudeau years they couldn't get the ear of Ottawa. Well, that has apparently changed now.
Yes. And I think my concern was going back to the 80s when it was Pierre Elliott Trudeau was in power and Reagan was in power, and we didn't see the pivot in the government that we're seeing today. And the economic deterioration continued. So I think the money that the government is spending is on productive factors, and that's okay. And so there is good debt and bad debt. Carney knows this. Carney's a smart guy, okay? And so if he's going to build things to retool Canada, yes, the level of debt's going to go up, but it's going to help productivity in the long run.
Jim, thank you very much. And it's been so much fun talking to you over the years as
We're
well.
going to miss you, Andy.
Thank you so much. Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. And we're going to stick with that theme of the Carney government investing in infrastructure and the economy broadly. Tomorrow we get the spring economic update and Ottawa announcing a Canadian sovereign fund. We'll have more after this. Ahead of tomorrow's spring economic update from the federal government, the Prime Minister announced Canada's first ever sovereign wealth fund. Mr. Carney says the fund will receive a $25 billion endowment and will operate independently from the government. Here is the Prime Minister outlining the scheme.
Today, we're proud to announce a new pillar of our plan, the Canada Strong Fund, Canada's first national sovereign wealth fund. This will be a Government of Canada fund, but more importantly, this will be a people's fund. It will be your fund.
Let's get more from Bloomberg's Brian Platt, who joins us from Ottawa. Amazing. They're talking about reviving war bonds, it seems. The people can buy into investment in Canada.
Yeah, there was the headline on today's announcement is interesting, but there's not many details to back it up. And so I think, we'll see what we get in the spring economic update tomorrow that you mentioned. Mm-hmm. We may get a little bit more fleshed out about how exactly this works. But right now we know the government intends to put in $25 billion. Ordinary Canadians, individual Canadians will have a chance to invest into it. And beyond that, it's a little bit vague how this fund is actually going to work.
Yeah, and how, I don't know, we haven't had the mechanics of how the private sector will take part, I don't think, Brian.
No, and you mentioned in your intro that it's independently managed, and that is indeed what the Prime Minister said. It's what the Finance Minister said, except that they also said that this fund is going to invest in major projects and help build major projects. And so, it raises a lot of questions about, what does independent mean? I guess it's about how maybe the charter of this crown, it's a crown corporation, we're told, so how the charter gets written. But does the government tell it what to invest in? Does it get to make its own decisions and assess the projects? I mean, this is really unclear right now. And so I'm hopeful that at least tomorrow we'll get some more information out of the spring economic update. But the Prime Minister also said this may be a few months of consultation before they actually sort of establish the details of how this is going to work.
Yeah, it's interesting. And normally you think of sovereign wealth funds as investing outside the country. I mean, Norway's is the classic $2 trillion or more US. And one of the ideas there was we won't invest all this oil wealth in Norway because it'll inflate the economy unduly.
Yeah, well, it's it's called a sovereign wealth fund, but as far as I'm not really aware of any other sovereign wealth fund in the world right now that works quite like this one. There's different examples. You've got like the Middle East sovereign wealth fund, Singapore, obviously Norway, like you mentioned, and so it's really It's an interesting concept, especially the fact that there's going to be a retail investing aspect to it. But really, beyond the headline that there's going to be a sovereign wealth fund and it's meant to help, it's meant to be like a patriotic way, essentially, for Canadian citizens to invest in some of the big projects they want to see built. But again, how these projects are picked, how independent this organization really is, whether there's institutional investors who are involved, whether all of the money is only invested in sort of these big major projects or not. There's a lot of questions and not a lot of answers yet. And so it's going to be interesting to see how this fund actually takes shape.
Mr. Carney couldn't resist giving us a preview of this economic update we're getting tomorrow, saying there'll be some good news.
Yeah, I assume that at least part of that has to do with the fact that high oil prices and high energy prices are generally good for the Canadian government coffers. Whether some of this is also some of the program cutting and the sort of the planned reduction in the public service, the headcount of the public service, some of that may play into it as well. But in general, when oil prices are high, it's good for the government deficit looks smaller, right, in a budget. So that'll be true for Alberta for sure, and I'm sure it's true for the federal government as well. And it's why it'll be quite interesting tomorrow to get a look at what the budget update is from the fall, because it may give Carney some more fiscal room for I guess in this case a $25 billion sovereign wealth fund, but maybe also for some other spending that he has in mind.
Brian, thank you very much indeed. Bloomberg's Brian Platt joining us now from Ottawa. Tomorrow, join us for special coverage of that spring economic update. And that all kicks off at 4 p.m. Eastern. And of course, the man at center stage will be the finance minister, Mr. Champagne. You can see him right there. Up next, ARC Resources shares jumping more than 20%. Shell buying the company in the deal valued at more than $20 billion. We'll have more after this. Shares in ARC Resources jumping today after Shell, the global oil major, agreed to acquire the Canadian natural gas specialist. I mean, this is a big producer, ARC Resources, and this deal adds about 370,000 barrels of oil equivalent today to Shell's portfolio. Our guest says this deal does demonstrate or reflect the Prime Minister's efforts to attract foreign capital to Canada. We're joined by Julian Klimochko, founder and CEO of Accelerate Financial Technologies. Thanks for coming on, Julian. For sure, that's a theme we're hearing today, that in some ways it's an endorsement of Carney's determination to get more energy, oil and gas onto global markets.
Hi, Andrew. Happy Merger Monday, and congrats on the retirement.
Thank you.
If there was a BNN Hall of Fame, you definitely get my vote. Now, with respect to this deal, $22 billion. So it's a huge win for Canada, and in my opinion, is a result of Prime Minister's Carney, his efforts basically globetrotting, trying to attract capital to the Canadian economy and the Canadian oil patch. We haven't seen a deal this big ever in the Canadian oil patch, $22 billion. It's the largest. The previous largest was CNOOC's acquisition of Nexen back in 2012,
wow,
which was $20 billion. And versus the previous deal in all of Canadian M&A, the previous largest was Rogers' acquisition of Shaw, announced 5 years ago. That was $26 billion. Just to give you a sense of the massive size of this deal, and in my opinion, indicates some success that Prime Minister Carney's having attracting foreign capital to the country.
It is amazing the sheer scale of this deal. We've seen other Canadian natural gas stocks such as Paramount or Tourmaline moving higher today. I guess people are thinking, well, if Shell is willing to pay that for natural gas in this country.
Yeah, no doubt. And certainly others could be on the radar. It definitely gets investors interested once you see a 27% premium and capital flowing into the space. Energy has been in a tough spot the last kind of 10, 15 years. So I think this deal is just, tremendous in terms of underwriting the potential of Canadian energy and the notion of Canada as an energy superpower. That's something that we really lost under the previous administration. And if you look at downtown Calgary 15, 20 years ago, it was just booming with entrepreneurs and startups in the Canadian oil and gas sector. And since capital effectively left, you've had that entire industry really decimated. And vacancy, for example, in downtown Calgary go from 0 to 25%. So this ARC deal, this Shell investment is tremendously beneficial, and I think will do wonders for the Canadian oil patch.
It is a foreign company, though, buying out a significant producer. I mean, a head office is lost, the stock gets delisted from the TSX. Should we be concerned that, sure, we're going to be exporting lots more energy, but foreign firms may just buy it up?
No, I think this is the exact opposite. Like I said, what was hollowed out was really the entrepreneurial spirit in the Canadian oil patch, and having $22 billion flow into the Alberta and BC economy in the energy sector. You have all these employees and executives that are cashing out of their stock, and you have all this sort of wealth created. And I think a lot of that will flow back into the oil patch. We have an absolute ton of resources to develop here. Our major issue is the capital required to develop these resources. So with that, we need more capital in. So we need 5 more deals like ARC, and then we'll have that energy superpower name to be recognized.
It's interesting that, like, Shell famously cut back on its oil sands, sold them off to Canadian Natural. But you note that they have been investing over the years in conventional energy. They bought Duvernay oil for almost $6 billion way back in 2008.
Yeah, they've been active in the country for a very long time and seemingly building out their natural gas presence. You got to remember that they have a 40% interest in LNG Canada, and they require supply for that. So it's great vertical integration for them. They have more feedstock for their LNG facility, and we can hope as Canadians that we see more LNG facilities built in the future to develop that resource and increase wealth for all Canadians.
How are you playing energy stocks now, Julian? Are you long the sector?
Yeah, we're long the sector after being short for many years because commodity prices are high. You look at the conflict in the Middle East, it seems like that's not going to be resolved anytime soon. But if and when it does, it just underwrites that Canada's position in the global energy sector. I think that risk premium has mitigated significantly and should attract not only capital, but premium valuations for Canadian energy producers. And with commodity prices this high, particularly on the oil side, these E&P companies are just making so much money, and they're going to reward shareholders with that. So yeah, we're long Canadian energy here. We think it has a bright future ahead.
Julian, thank you very much indeed. Really appreciate it. Julian Klamochko, founder and CEO of Accelerate Financial Technologies. Up next, those closing bells on Bay Street and Wall Street. There you have it, the closing bells at the NASDAQ. Ericsson, one of the venerable names in telecom, ringing the closing bell. In New York, it's the 2026 NYSE Space Summit. And at the TSX, it's Roxmore Resources closing the market. They're working on their Converse gold project in Nevada. You're watching The Close on BNN Bloomberg. And here's how the markets are settling out. Toronto down a little bit, but the S&P 500 and the NASDAQ Composite both closing at new record highs. Toronto is still down about 2% from its high at the start of March. Some stocks of interest, another look at ARC Resources. Interestingly, that stock has suffered over the past while because of problems at their Attachie gas assets. And so Shell presumably thought, well, that's another reason to swoop in here. Investors are slightly disenchanted with the company right now. Kelt Exploration higher, along with a bunch of other Canadian gas specialists. About almost 2/3 of their production, Kelt's, was gas last year, and another 14% natural gas liquids. So it's up. Lithium Americas higher in trading today, up around 13%. Let's have a look at some of the stocks that lost a little bit of altitude today. B2 Gold slipping. They have been plagued with delays at their big new mine in Canada's north, the Goose Mine, and that often happens. New mines, new ambitious mines run into teething troubles. That has been weighing on B2 Gold. Allied Gold also down as well. Gold itself losing about 1% in trading today. And there's MDA Space. Now, that stock has been doing just fine with the flood of money into space and satellite assets. And of course, we got that gigantic SpaceX IPO not too far off, but MDA Space giving up a bit of altitude today. Okay, we're in for a treat. We're joined by Bloomberg's equities reporter, Stephanie Hughes. Stephanie, great to see you. ARC Resources, just remind us what went on with that stock today.
Absolutely, Andy. Happy Monday. Always great to see you. So unsurprisingly, ARC Resources was the top performer on the TSX today, just blowing past the competition with gains of over 24% at its highest point, and managed to keep those gains as the trading day went on. So that marked its biggest intraday boost since March 2020. So just over 6 years since we've seen a move of that magnitude. And it was enough to bring the stock price up to its highest level since 2014. Mm-hmm. And that all comes down to, that comes after the oil and natural gas firm agreed to be bought by London-based energy firm Shell for a cash and stock deal valued at $22 billion. That's including the assumed net debt. Mm-hmm. So analysts are broadly viewing this as a fairly valued deal. Part of it's because of the issues at some of its projects that you alluded to before we started talking. And that's also that would also make Shell one of the largest producers in the Montney Formation in British Columbia. So the deal also cast a ripple across the Canadian energy space, really leading to a rally in names like TSX-listed energy names like Kelt Exploration, Birchcliff Energy, Advantage Energy, and many others. So essentially the top 10 performers on the TSX were just dominated by these energy names because of the hype around this deal, Andy.
Yeah, it's interesting. The CEO of Shell, quoted as saying, "Those molecules I'm buying are pointed towards Asia to be exported as LNG." The Prime Minister talking about yet another bucket of money that will be used to build up the country's economy and infrastructure. They're calling it a sovereign wealth fund, but it's kind of different from sovereign wealth funds around the world. Anyway, Bird Construction hitting a record high today.
Yeah, that's right. There was a few interesting details around that wealth fund that Carney's government described, and there was a few stocks that immediately moved on that. So Bird Construction was one of them. It is a general contractor firm, and those shares gained by just over 5% at their highest point, did end up easing those gains as the trading day went on, but it did briefly bring the stock to a new all-time high. So that's because Carney's government announced that Sovereign Wealth Fund, Canada's first, as it's reported. As you mentioned, there's a bit of interesting nuances there, vague details, but we'll get more on it, I'm sure, as the week progresses. But it is the intent of it is to provide financing for these large infrastructure projects, these major projects that are supposed to be nation building. So the Canada Strong Fund, as it's called, is hoping to pull in about $500 billion over a 5-year span. And that news has provided a boost to names like Bird Construction, which works in commercial and industrial, institutional projects. So they would probably get some contracts or some kind of a windfall if this money starts chugging along. But also gave a lift to companies like development firm Aecon Group and the real estate consulting firm Altus Group. So there's a few companies just moving a little bit higher, anticipating that they might get a little cut of the action, Andy.
Thanks very much. Because the classic definition of a sovereign wealth fund, it's meant to invest surplus revenues, profits from commodity exports. But I don't know if Canada has much in the way of surplus revenue right now with the big deficits we're running. But anyway, I'm sure that'll be thrashed out in the debate over the next few weeks. Thank you very much indeed, Stephanie. Stephanie Hughes of Bloomberg. Let's get some stocks on the move south of the border. We're joined by Bloomberg senior equities reporter Bailey Lipschultz. Bailey, thanks very much for joining us. Domino's, what's happening there, please?
Andy, not too great for Domino's. The stock closing at the lowest level in almost 3 years was down pretty sharply today, and this came after earnings were pretty lackluster, especially as management talked about the last quarter in terms of same-store sales really falling short of what most Wall Street analysts were looking for. As you can see, this is a stock that has done nothing but really gone down and to the right over the last 12 months. But really a brutal report when you think about the fact that the management team was really talking about the pinch that consumers are feeling with inflation being higher. Obviously, we've talked kind of ad nauseum about the costs of and the knock-on effects of higher prices for consumers at the gas pump, and obviously that continuing to seemingly show up for this company. Again, it's interesting in the backdrop where I believe the S&P closed at another all-time high, but we are seeing and hearing from consumer-facing companies that their biggest customers are struggling, and that's something that really stood out when you look at this. They were also a bit pessimistic on their global footprint and global same-store sales as well.
Interesting story here. Critical Minerals is buying European lithium for more than 800 million US, and this gives them full control of a rare earth deposit it's working on in Greenland.
Yeah, that's the big step forward, that deposit in Greenland. Yes, all things mining are quite expensive and time intensive as well as capital intensive. So it'll be interesting to see how this plays out with expectations that this deal will be completed sometime in the second half of this year. But this is another big step for Critical Minerals. As you can see with the stock rallying today, again, not really trading at like its highest level in the last 6 months by any stretch, at highest level, best close in the last few months. But a 20% move nonetheless is nothing to ignore. It does seem like, at least from the initial analysts in Wall Street, read that this is a positive step for the company. But again, what does this ultimately mean with the White House being vocal about potentially wanting to do something in Greenland, then seemingly walking that back, or at least cooling on making that priority number one? It does seem like it's a step forward for the company, and it doesn't seem like, at least according to some of the initial reports, that it was seen as an overpayment. But again, you have to have some success with building out that mine.
And then finally, Flowserve are facing a dissident investor.
Yeah, Starboard coming out saying that Bloomberg reporting that Starboard has taken an activist stake in the company. It's always interesting with these kind of stories because typically you see stocks trading maybe at a 52-week low, but as you can see, the stock has essentially doubled over the last 12 months and was working back towards that peak that we saw back in February. Bloomberg reporting that the activist investor really wants the company to focus on margin expansion, something that could potentially be unlocked. The big thing to know about Flowserve is their name kind of describes what they do. They operate in selling and maintaining the bits and pieces around piping and kind of the flow of oil and gas and other infrastructures. The big thing that the company hasn't really leaned into has been the nuclear power and some of those other operations. So certainly a potentially untapped market and something that's really been a big theme that we've been tracking for the last few months. So it'll be interesting to see if Starboard does come out and confirm the report and what they want to disclose as it relates to engaging with management, because as we know, again, normally activists kind of cause a scene when a stock's trading near a 52-week low, not near record highs.
Bailey, great hearing from you. Thank you very much indeed. Bloomberg's Bailey Lipschultz. Okay, so U.S. stocks hitting a record high today, despite the lack of progress in the Persian Gulf talks. We're going to get an outlook for the rest of the week after this. Markets are trying to decide between the risk on the Iran war front and earnings that have been pretty strong so far. Let's get more from Thomas Martin, Senior Portfolio Manager at Globe Alt Investments. Thanks very much indeed for coming on.
Great. Thanks for having me on your program.
Start off with the threat of the Persian Gulf. I know it changes day to day with diplomacy and tweets, etc., but the market seems to be discounting the risk of high energy prices for now.
Well, they do, and you have oil here at this intermediate high level or low high level of 100. It's not back in the sweet spot range, which is somewhere between 60 and $80 a barrel, but it's not up at very high levels, in excess of 125 and 150. But what it's telling you is that there is still a fair amount of uncertainty, and that as that works through the system, it could result and is already resulting in some dislocations in various economies around the world, and even to some degree in the U.S. But that's a slow burn, really, and depends on when things can start to get better. And in the meantime, you have the very immediate thing of earnings reports from companies, and particularly this week, you're going to get all the hyperscalers, but we're getting a lot of positive reports about AI and about the need for the chips and for the data centers, and the earnings growth that is associated with that.
It's interesting. You have one stock that is influenced by AI here. Apparently, people are making money selling AI-produced songs on Spotify. And you like the look of the company. What draws you to Spotify shares?
Well, so before we had this part of AI was used by Spotify to have just a really good engine for predicting what their clients would want to listen to and helping them to segregate their audience into tiers and to be able to give them what they wanted at a price that they wanted. This idea of making music on your own is a great idea, and there are some fans who are going to do it. But it's not really, in my view, the acts that gets people to listen to music. They need to have an emotional attachment to it that they associate with the artists who make it and the ability to see those artists, et cetera, and to know lots of different kinds of artists in the music that they're making. So although it certainly could be a threat, it is something that potentially Spotify could monetize itself, and we don't view it as an existential threat to the company.
Right. And you do like the look of Spotify shares broadly?
Well, yes, the stock is down significantly from its peak, and I think that has to do with some uncertainty about AI, and also there was a recent lawsuit filed not just against Spotify, but saying that they were helping certain songs get played, kind of like back to the old DJ eras.
Payola, yeah. Yeah, go on.
Yeah, exactly, right. But they've been very transparent, at least they say, with how they make their choices and how that's done, and it's documented. Although I haven't seen that and compared it to what's in the allegations, I think that they have a good interest in not doing that and in having several DJs that cater to their clients. Again, they're very clear that they know who their audience is, and that they will live or die by being able to serve that audience.
Another company.
So we think it's an attractive stock and good growth rate.
Thanks. Another company that tech-related company that's well down from its highs, Uber, and you would tend to be a buyer now of Uber?
Well, we like Uber. It also has been a laggard so far this year. And the idea, I guess, or the fear is about, AVs and self-driving, et cetera. And how Uber has reacted to that has really been just kind of amazing. They've really used their position as an aggregator and as a data aggregator to be able to get ahead of using AVs in their fleet. And so instead of the AVs taking over Uber's business, Uber is having the 15 or 20 AV companies that are starting to really be able to put cars on the road, be their suppliers and have a competitive advantage by helping them to do better in their business, but becoming dependent on Uber for them to getting to scale and make money in a more rapid and assured pace. So we think Uber has really got it kind of dialed in, and as that becomes more apparent, the stock will re-rate again.
Just we had that big deal, as I'm sure you saw today, ARC Resources being bought by Shell. What about oil and gas stocks generally? I know we touched on oil earlier in the segment, but are you over or underweight energy?
Well, we are market weight, which is a chicken way of saying that we recognize that energy prices are high and are likely, we think, to remain high in the near to intermediate term as a resolution may be slow to come about. But the stocks have also run a good bit, and so we want to be cautious here and watch how oil goes. So, we want to have the full exposure there, but we're not ready to kind of back up the oil tanker, so to speak.
Thomas, thanks very much. Thomas Martin, Senior Portfolio Manager at Globalt Investments. Really appreciate it. Up next, Ottawa announcing a sovereign wealth fund. Our guests had been calling for one for months. We'll find out why after the break. For more on Canada's new sovereign fund, we were joined by John Ruffalo, founder and managing partner at Mavericks Private Equity. He believes the fund could help the economy if it's executed properly. Let's have a listen.
It is the size of the Alberta Heritage Fund or thereabouts, but it pales into comparison of the Norwegian Fund, which is topping at around $2 trillion.
Yeah, that's not even close to that. You've been calling for this for months and probably longer, yes. I imagine. Will this make a difference at 20? It's a start, but will it make a difference? Will we see it used properly?
Yeah, now there's still lots of details to come out. What I hope is that this is just the seeding of it, but there is an opportunity to really scale this up and really have a source of permanent capital, not only for Canadian investments, but to support the wealth of Canada by even investing abroad as well. So I hope this is just really the tip of the iceberg.
Do you think there is interest in wanting to invest in this?
Well, I certainly there's the opportunities. Now, the one thing that remains a little unclear to me is, in the press release, they made reference to some infrastructure type projects, but there is a dearth of capital available for venture and growth opportunities, particularly in the innovation space. In the age of AI, we're seeing all these countries around the world invest heavily. There's an opportunity to invest in Canadian-based opportunities here as well. So I want to understand more on the breadth of the opportunity, and I think more capital is welcome, and it might attract private sources of capital as well.
And how have we done at things like this? Are we any good at it?
Well, this is the key here. So governance is absolutely critical. What no one wants to see is a government slush fund achieving, really political points and money wasted. We need proper professional governance models like the CPBIB, the most recent Canada Growth Fund, CDPQ. There is a number of examples, but this is critical. The details haven't been released on that, but I'd be looking towards that to make sure we get it right.
And is there a legitimate worry that this could end up as a bit of a pork barrel?
Well, it is if it's just a crown corporation being dictated by whoever government is in power, then yes, that is the big risk. So, I know this government here was very concerned around the governance model. And so I am quite curious to see where they might be landing.
And what would you like to see for a governance model?
I'd like to see this independently managed with no political influence. And their job is to not only invest in Canadian sovereign opportunities, but also achieve a rate of return so that this continues to grow and is completely sustainable for all Canadians.
And what's a good rate of return to you?
So if you compare this as a proxy to the long-term pension fund rate using 20 plus years, every single major pension fund has generated a return of at least 7% compounded. And if the source of the capital is our debt or our bonds at 3.5%, then you're generating really a spread on our borrowing rate versus what you're able to generate. So that gives me optimism that we could replicate the Canadian pension fund success here as well.
And should we be modeling on another sovereign wealth fund that, like, I know they have them in the Middle East? You mentioned Norway. Is there one that might be comparable to what we are hoping to do?
Well, I mean, there's a variety of them. There, as you indicated, the Middle East. There's a couple in Asia, but Norway is the example that most people use. At the time that it was created, it was approximately the same size as the Alberta Heritage Fund, but it had independent governance, and look at the difference. And the one thing that Norway had, which I think is interesting, there's actually two funds inside of it. One that exclusively invests in domestic sovereign opportunities in Norway, and a much larger fund that invests around the world in order to generate a consistent rate of return so that you have the money sustainably to make the domestic investments.
And is that working?
It's working to the tune of $2 trillion.
They have they had a tremendous amount of oil too, right?
Yes, and now this is the lost opportunity for Canada, is that, we had all these oil revenues, and we didn't have a big deficit. And if we did this properly, we would have started this 40 years ago. But the second best time to start this is right now.
And how is the Alberta one doing?
Well, not very good. It started earlier than Norway. It actually was growing larger, and then I cannot recall exactly. I want to say it was during the Ralph Klein administration that they took money from the fund to keep taxes lower and to fund the deficit, and others were pushing it for a sales tax, and they made a political decision. And today, I think the size is around $28 billion, and it could have been $2 billion or thereabouts.
2 trillion.
If it was untouched.
And now, do you think politicians will have the stomach to step back and not have control over money?
Well, we did it with CPBIB, right? This is taxpayer money to fund the future CPB payments. And there's an independent board, independent management. It works extremely well. It works closely with the Department of Finance, but it is independently managed. So we have those models and a proven success story in Canada. Why not this as well?
Up next, we'll find out why nations and regulators are concerned about Anthropic's latest software AI model and what it means in the AI race. And we have some breaking news for you. Celestica stock hit a new record high today. It's a market darling. Investors anticipate massive continued demand for the advanced computing rigs that it puts together for handling AI number crunching. So the company is out with its latest quarter. It's boosting its revenue forecast for the full year. Adjusted EPS, profit per share, in the latest quarter, $2.16. The estimate was only $2.07, and revenue surging 53% to $4.05 billion, slightly ahead of the consensus. And the company sees revenue as high as $4.45 billion in the current quarter. Estimates only $4.17, and it sees profit going from $2.14 to $2.34 a share US, and the estimate is just $2.13. So looks like a strong quarter for Celestica. Rogers Communications is offering buyout packages to about half of its workforce. The Globe and Mail says the telecom giant is making these voluntary departure packages available to employees across multiple divisions as it moves to cut costs significantly. This offer comes as the telecom industry in Canada faces slower revenue growth, and Rogers is also dealing with high debt levels. The company has announced plans to cut capital spending by up to 30%, and Rogers, of course, competes with our parent company, BCE. Elon Musk and the OpenAI CEO Sam Altman head to court today in their legal dispute over artificial intelligence. Musk is suing Altman, accusing that company of abandoning its original non-profit mission in favor of commercial interests. OpenAI has pushed back, calling the claims baseless and saying Musk is just trying to slow down a competitor. This case is expected to put the spotlight on how AI is governed and commercialized. There's a lot of talk about how AI will change the world, but we're only at the beginning of the transition. For example, moving from assistance to autonomous execution in high-skilled fields, especially cybersecurity. We were joined by Gregory Allen, a former U.S. government official in AI policy.
Anthropic has told them explicitly that they should be worried. For over a decade now, people such as myself have been noticing that machine learning, artificial intelligence capabilities are getting more and more powerful across a whole host of domains. And one of those really interesting domains is in cybersecurity. Now, because the entire attack takes place in the virtual environment, the digital environment, that makes it a really attractive place to gather training data. And anytime you can get a lot of high quality training data, you can build powerful AI systems. And this latest model from Anthropic, Mythos, really crossed a number of interesting thresholds, not just the ability to identify new computer security vulnerabilities, which other AI models had been able to do so previously, but the ability to do so and then autonomously execute the attack from an end-to-end perspective. And going through a number of really important open source code repositories, Anthropic has already found hundreds or thousands of cybersecurity vulnerabilities, many of them critical potential breaches. And so that's why Anthropic went to the government, went to the big banks, went to critical infrastructure providers and said, hey, this exists. You live in a new world now, and you have to be armed against it.
And this is interesting. Cybersecurity, you say, has had a massive labor shortage for 20 years. Because hackers are, well, they're difficult to train, and I guess some of them are difficult individuals.
Yes. So if you think about an agency such as the National Security Agency, that's the best computer hackers in the United States government. There's only thousands of skilled individuals here working at that agency who are really capable of executing a high-quality cyber attack, right? There's not millions of these people on planet Earth. And the number of vulnerabilities that they can discover, the number of vulnerabilities that they can exploit, has been for a very long time fundamentally labor constrained. These are experts and the work they do is hard. But what if instead of having 2,000 people in an office campus, you could have 1 million AI agents living in a data center with equivalently good skills? Whoa. And not only there are 1 million of them, you can create more of them essentially at will, and their ability to scale up and act autonomously is basically what you as the decision maker decide it should be. This is a very different cybersecurity landscape on both the offensive side and the defensive side that we're likely to be in the next few months.
Mythos is doing this, Anthropic is doing this, or adopting this approach. They're working with 40 key companies, banks, and government agencies. Just describe them to introduce them to Mythos and its power and its powerful attributes. Just walk us through how Anthropic is handling this, please.
Well, essentially, Anthropic is developing these new capabilities, and it recognizes that all segments of the economy are effectively vulnerable to the existence of these new capabilities. But Mythos and effectively all artificial intelligence technology can be used like any tool for good or for ill. The same capabilities that discover cybersecurity vulnerabilities can be used to exploit them offensively or to guard against them and patch them defensively. And so fortunately, Anthropic has, as sort of a good corporate citizen, gone to the government, gone to these key businesses and industries and said, here are all of the critical vulnerabilities that our new model has identified. Before we make this available to our general customers, you need to start patching all of these vulnerabilities. And it's noteworthy that Anthropic is really doing this at a cost to its own business. Anthropic could be serving Mythos to customers and earning revenue off the extraordinary capabilities off of that model. Instead, it's withholding it and only releasing it privately to a trusted select group of businesses and government agencies to help them patch their security vulnerabilities before it's too late. But while Anthropic is out front with this new era of AI capabilities, we should expect others in the field, other US companies, other companies in China, for example, to reach this level of capability at some point. And that's why it's very important that we use this critical window of opportunity to strengthen our cybersecurity defenses before China reaches the same capability threshold.
I know this is kind of an apocalyptic scenario, but are we going to have to go back to basics on the internet? I mean, will things like secure banking be even possible in an era that where we've got these models?
Yes, I think fundamentally this can work, but the future being good is not guaranteed to us. It must be the result of our efforts and our wisdom. And in this regard, as I said before, these advanced AI capabilities can be used to strengthen cyber offensives, and they could also be used to strengthen cyber defenses. And the fact that Anthropic is deploying these capabilities in this kind of a way shows you what the future is going to look like. It really depends upon the good guys having a technological edge and being able to reach that next threshold of cybersecurity defenses before others are in a similar position of capability and coming up with better hacks. That's the challenge that we're in right now. But it's also worth pointing out that we've already been living with a pretty significant degree of cybersecurity vulnerability that's held in place both by geopolitics and the general deterrence between various countries, and also the labor shortage that I talked about.
Wow.
So this AI situation is going to change the labor shortage dynamics, but as long as we're putting more and better resources towards defenses, yes, online banking and other critical online services can survive.
Gregory Allen, a former U.S. government official in AI policy. Up next, how can investors access equity value being created in high-growth private companies? We'll drill into that after the break. Companies, in many cases, have been staying private longer, but they need investor money. How can you invest even? How can you play high-growth startups and look for opportunities as well outside the U.S.? We are joined by Robert Natzler, investment manager at the private companies team at Baillie Gifford. Thanks for joining us. So Baillie Gifford, correct me if I'm wrong, a British-based investment manager, almost 180 billion pounds under management.
That's correct. And for the last 15 years, we've also been a private equity manager deploying capital into high-growth companies all over the world. And I think it's really important that you mentioned not just growth in the US. I think one of the things that we see again and again and again with very sophisticated investors in North America is this assumption that just because a lot of innovation happens in North America, that's the only place to find innovative companies. And we'd say whether it's ByteDance coming out of China or Vinted coming out of Europe or Takeva, which is now Portugal's first unicorn, there's a ton of growth and value to be had all over the world, including in private markets.
And but before we get into the possible advantages, what do you offer? Do you offer retail investors a product yet?
Yeah, so we've got a bunch of different vehicles that are available. So we've got a GPLP series family for institutional investors. But for retail investors, we've got a fund called the Schiehallion Fund. It's just joined the FTSE 250 index listed on the London Stock Exchange. And so it's as easy as trading any other share.
Tell us about this phenomenon of companies staying private longer. Is it partly the regulatory burden of going public?
I think you can point to Sarbanes-Oxley in the early 2010s as one of those regulatory moments that increased the burden of being public. But really, the trend goes much, much further back than that. If you look at the 1990s, and this is University of Florida data, back in 1997, the average age of a company when it was going public was just 5 years. Fast forward to now, that's 14 years.
Wow.
And you can see through that period, ever increasing ages. The simple truth is that companies no longer go public because they need the capital. They go public when they're ready to go public. And in between, they're increasingly able to tap into an ever larger pool of global capital that's willing to back highly liquid, developed private companies. You mentioned startups at the beginning, and I know that's where people's minds always go. They think of these small companies backed by venture capital. I'm not talking about that.
Okay.
If you look about the growth equity we have in our portfolios, at the time of investment, these are typically businesses doing 180 million of revenue. They're growing at over 70% top line. They still have their founders in the chair. Like in your grandfather's market, these were public companies. Like, don't forget, Amazon IPO'd at a $1 billion IPO valuation. Tesla, 2010, it came out at $2 billion. Right now in our portfolio with Anthropic and SpaceX, we have two companies that are already looking at a $1 trillion or more valuation while still being private. And so it is just a different world now from what it was 20 years ago, 25 years ago. And if anything, we're not seeing signs of the trend decelerating anytime soon.
So, and just to loop back there, so you've launched essentially an ETF in London that will hold these investments?
It's a closed-ended fund, so it's a listed balance sheet.
Okay.
And on this balance sheet, we hold SpaceX, we hold Stripe, we hold Databricks, we hold ByteDance out of China, we hold Anthropic. Shareholders get access to all of these underlying companies just by buying the shares in the open market.
That's, yeah. Sorry, give us that again. Sorry, what is the mechanism? It'll buy what shares?
So it's just like a public company. So like any public company, we've got a balance sheet. Now, on that balance sheet, we hold the shares of some of the best private companies in the world. We like to talk about it as the future of the NASDAQ today. And so when you look at the portfolio of, it's called Schiehallion is the name of the fund. The ticker is MNTN, as in mountain. Because Schiehallion is the most beautiful of the Scottish mountains. We believe that very fervently. We hold SpaceX, we hold ByteDance, we hold Databricks, we hold Stripe, we hold Anthropic, we hold a fantastic Italian company called Bending Spoons that not enough people in North America know about yet. And we hold a ton of other fantastic businesses. But it's a great way to get exposure to private companies for the retail shareholder who otherwise finds themselves sitting in public markets just watching the second half of the movie.
What about the risk, though, that people, retail investors, are putting, maybe not with your vehicle, but people are generally being encouraged to put money into private equity when the disclosure and risk level are not what they're used to?
I think people need to be really, really thoughtful about the risks that they're willing to take. One of the classic risks in private equity is you're investing money without any guarantee of liquidity at any point in the future. In other words, you're just having to trust that those companies will be sold at some point in the future and you'll get your money then. If you're a sophisticated institutional investor and you're managing a portfolio of private equity positions, you can maybe handle that risk. But as a retail investor, you want to be really careful about thinking, am I going to want to lock up my capital for that period of time? But that's exactly one of the things that we're trying to solve. Because in our case, the shares are liquid. People trade them on the stock exchange. It's a member of the FTSE 250 index. And so we try and give people exposure to the underlying companies whilst getting rid of those liquidity risks that have classically dogged private equity.
It is amazing, all right. And speed of information is so much faster, isn't it? It's so incredible that people used to wait for a prospectus to be mailed to them. But now we're really in an instant information transfer almost.
It's a different world. I remember one of my mentors when I was starting out in the investment business, who was a very experienced Scottish fund manager, and he was remembering when the New York Times used to have to cross the Atlantic on a boat, and so he was guaranteed to get the news later than everybody trading in the New York market. So we're definitely in an age now where information is instant, but just because information is swift doesn't mean that access to information is equal.
No.
Having really good relationships with the companies and the engineers at the cutting edge is an endurable competitive advantage. There's a huge difference between the quality of information that people receive from reading shareholder disclosures and the Financial Times compared to what they can access if they're able to build trusted relationships with the operators at the coalface.
That's interesting. Yeah, it hasn't changed really. Human beings, trusted relationships are where it's at. Robert.
People are people. You can bring in AI, but that's not going to go away.
Robert, thanks very much indeed. I hope you haven't sparked controversy now with your predilection for a certain Scottish mountain. Anyway, we better leave it there. Robert Natzler, investment manager in private companies at Baillie Gifford. Okay, a Kenyan runner has won the London Marathon in a record time of 1 hour, 59 minutes and 30 seconds. We're going to talk about his shoes after the break. This kind of hurts to even think about. Two men got through the marathon, the London Marathon, in less than 2 hours. And on their feet, they had new ultralight $500 US shoes from Adidas. And Adidas shares have gone up. Let's get more from Bloomberg retail reporter Lily Meyer. Lily, thanks for joining us. Imagine these two fellas ran at 20 kilometers an hour for 2 hours. You're horrified too.
Yeah, it's amazing.
Sorry. Yeah, so quite a boost for Adidas. I mean, this is the kind of publicity that they love. They must be cracking open the champagne today because these two guys were wearing their super lightweight shoes. Hello, Lily? Did we lose you?
Hi, I lost you for a second at the end there.
Sorry, Lily. Just walk us through this story. Good news here from a retail point of view for Adidas.
Yeah, absolutely. It's very exciting for Adidas. I think that, the running category is very competitive right now. And so for Adidas to really nab this sub 2 hour marathon is a huge feat.
Apparently, it has been done in history previously, the sub 2 hours, but it was in a run in Vienna that wasn't eligible for world record status. I can't believe it. These shoes, they weigh just mere ounces, only about 3.5 ounces.
Yeah, it's amazing. I mean, Nike had invested quite a lot in, getting the sub 2 hour goal, and Adidas was able to really make it happen with these shoes on a in a kind of world record qualifying race.
Oh, that's interesting. So Nike had been aboard this trying to get their shoes on athletes who would do it in less than 2 hours?
Yeah, so several years ago, Nike really invested in trying to make it happen. And, that Vienna race that you referenced was a Nike organized event.
So I'm looking here.
Yeah.
Sorry, Lily, I cut you off there. I'm just looking at Nike stock, NKE, over the past 5 years. It has suffered, down about 63%. Adidas is down as well, though, almost 50% in US trading. But Nike's had trouble, hasn't it, reigniting excitement over its brands?
Yeah, exactly. So Nike leaned very heavily into lifestyle shoes, and since it appointed its new CEO about, a year and a half ago, the company has been really focused on getting back into sports, and running is one of the priorities for Elliott Hill, the new CEO. So, and it so far has been doing well, getting back on track with running. But I think, this is a moment where Adidas has obviously been getting a lot of attention.
Lily, thank you very much indeed. Lily Meyer of Bloomberg. Thanks very much indeed for watching The Close.